If you're a young investor in 2026, this might be the most confusing financial environment you've ever seen. Not because there are no opportunities, but because the rules of the game have changed. Markets are near all-time highs. AI is reshaping entire industries. Living costs are rising. And social media is telling you that if you're not rich by 25, you're behind. But here's the truth. 2026 won't be impossible for young investors. It will just punish the unprepared. And in this video, I'm going to break down exactly why young investors will struggle, what most people are getting wrong, and how you can avoid becoming part of that statistic. Let's start with the first problem. One of the biggest challenges for young investors in 2026 is simple. Most assets are already expensive. Stocks are trading near record highs. Major tech companies are priced for perfection. AI companies have exploded. Crypto has had massive cycles already. And when markets are expensive, your margin for error becomes very small. In 2020, almost everything went up. In 2021, almost everything went up. That creates a dangerous mindset. People start believing investing is easy. But historically, when markets are expensive, future returns tend to be lower. Volatility increases. Corrections become sharper. Young investors entering now don't get the easy phase. They get the disciplined phase. And that's harder, because when you buy near highs, you need patience. You need emotional control. You need long-term thinking. And most young investors are not taught that. They're taught speed. Which brings us to the next problem. Young investors today are not competing only with the market. They're competing with perception. Open TikTok, open Instagram, open YouTube Shorts. You'll see, I made $10,000 trading today. This coin will 10x. This stock will explode tomorrow. It creates urgency. It creates comparison. It creates pressure. And pressure leads to bad decisions. Here's the reality. Most real wealth is built slowly, but slow doesn't go viral. So young investors feel like they're missing out. They start chasing meme stocks, high-risk crypto, options trading, leverage. And they don't realize the people posting wins rarely post losses. 2026 will punish emotional investing because volatility is likely to increase, and volatility destroys impatience. Now let's talk about something rarely discussed in finance videos: the cost of living. Rent is higher, food is more expensive, insurance costs more, education debt is real. Saving money in your early 20s is harder than it was for previous generations, and investing requires capital. So young investors face a double pressure. They need to invest early to build wealth, but they also struggle to save enough to invest comfortably. This creates frustration, and frustration leads to over-risking. Someone with $500 saved might think, if I don't turn this into $5,000 quickly, what's the point? That mindset is dangerous, because investing is not about fast multiplication, it's about consistency. In 2026, discipline will beat aggression every time. Another factor that will make 2026 challenging is job uncertainty. AI is not a future concept anymore. It's here. Automation is improving. Companies are becoming more efficient. Entry-level roles are being reduced in some industries. And young investors rely on one main thing: income. If income becomes unstable, investing becomes harder. That doesn't mean AI will destroy everything, but it means skill gaps will grow. Those who adapt will thrive. Those who stay passive may struggle. Financial success in 2026 won't just depend on what you invest in. It will depend on your earning power, your adaptability, and your ability to increase your skills. Investing without increasing income potential is incomplete strategy. Here's something uncomfortable. At some point, there will be another correction. Maybe not tomorrow, maybe not next month, but markets move in cycles, and young investors who started recently may not have experienced a real crash. A real crash tests you. You see your portfolio down 20%, 30%, sometimes more, and your emotions take over. 2026 might not be the year of easy gains. It might be the year of psychological testing, and that's where most people fail. not because they chose bad companies, but because they panic. Now let's flip this, because struggle does not mean failure. Here's how young investors can actually win in 2026. 1. Focus on skill growth. Increase income potential. Learn valuable skills. AI is a threat if you don't adapt. 2. Think in 5 to 10-year windows. Stop thinking, what will this do next week? Start thinking, where will this be in 5 years? 3. Avoid over-leverage. No emotional options trading. No life savings into one coin. No gambling disguised as investing. 4. Build consistency. Invest monthly. Small amounts. No drama, no hype. Boring wins long-term. 5. Detach from noise. The loudest investors online are rarely the richest. Silence builds wealth. Noise chases attention. 2026 won't be the easiest year for young investors, but it might be the most important, because this is where habits form. This is where discipline develops. This is where you decide, will you chase fast money or build slow freedom? Markets don't reward excitement, they reward patience. And if you can stay calm while others panic, you won't just survive 2026, you'll be ahead when the next cycle begins. If you want more breakdowns like this, subscribe.